Most of the ways that I talk about getting rich and making money and investing are pretty boring, so today I'm going to talk about probably the most exciting thing that I'm ever going to talk about as far as investing is concerned, and you can tell how excited I am. Today I'm going to talk about borrowing money to invest, which is called leveraging. It's a risky technique, but it's also a very potentially rewarding strategy. Now you can borrow money to invest in a lot of different things, like last video I talked about borrowing money to invest in real estate. You could borrow money to invest in a company you want to start, like I did. You could borrow money to invest in your friend's company or idea. But today I'm going to focus on borrowing money to invest in the stock market. Not just a stock in general, but an actual diverse portfolio within the stock market. Now you should never ever think about borrowing money to invest if you are a few things. First, if you're a conservative investor that doesn't understand that the stock market is going to go up and down, don't even think about it. Second, you should have a long time horizon. You need at least 10 years, and I would preferably like to see more if you're going to borrow money to invest, because a lot of things can happen in a short period of time. You also need to know that you're going to have solid, steady cash flow to be able to afford the payments on this loan, or at least the interest payments on this loan, so that you don't have to sell it if it's gone down. Now, I'm also going to talk about today why leverages get such a bad name, because in 2007 or the early 2000s, leverages were sold to everybody. It was just ridiculous. I've seen so many that are still in force that aren't even above water because they were just so bad. But in the early 2000s, before there was a lot of regulations in place, advisors would just walk into a kitchen table and be like, well, you don't have any money, you're a bad client, but you've got a little bit of equity in your house, so just borrow it and invest. Or, take out this loan and borrow all this money to invest in the stock market so they could make a huge commission, but not even really looking at the client scenario and saying this person shouldn't be in a leverage whatsoever. So they'd get all these people to invest into the market and borrow all this money, and let's just say you borrowed $100,000 on this loan and you put it into an average Canadian mutual fund like a growth portfolio, and in 2008 you immediately watched it over the course of 6 months drop 32% to $68,000. Now you're freaking out. This guy's the worst advisor of all time in your mind, so you decide to sell. Now you pay back the $68,000 that you have left, plus you probably had to pay DSC fees, so even less. Now you're paying back this loan that you have nothing to show for it, which is terrible. But besides the point, if that person was properly put into a leverage because they were an actual good fit, and I know how hard this would have been in 2008, 2009, because it was terrifying for everybody, and I hope I never have to see it. But if those people did that and stayed in until today, their account would be worth somewhere in the range of about $160,000 today, which isn't too bad compared to selling out at a loss and then paying back the loan for the next 10 years. So that's a really bad case scenario of what can happen, but as you can see, if you hold out, you should be able to rebound if it's right for you and you can handle it. Now, I don't want to talk about like a leverage to try and sell you on the idea that you need to go out and do this by showing an example of you borrowing $100,000 20 years ago in investing into Apple, and now you're worth like $100 million or something ridiculous like that. I want to talk about a reasonable example. And what's cool about leveraging is that when you borrow that money to invest, you're borrowing it and you're investing it in a non-registered account. So not a tax-free savings account and not an RSP. Those are different loans. Now you get to write off the interest of that loan. And you could also get interest-only loans, or if you borrowed against your HELOC, where you're just paying the interest on the loan. And personally, that is what I would do. So that's the example that I'm going to use today, is that Kent went out and he borrowed $100,000 at 4% interest. So I owe $4,000 interest every single year. Broken into months, I owe $333 every month in interest to have $100,000 invested into the stock market. Now let's just pretend that my highest marginal tax rate is 40%. Some Canadians are going to be higher, some lower, but you should have a high marginal tax rate, a high income if you're wanting to do a big leverage anyways. So now effectively my payments on this loan are actually only $200 because of the tax savings. So let's see what happens over the course of the next 20 years. Well, I'm just let that grow. I just pay the $200 or $333 every single month, and interest rates never change, which is not the case. That wouldn't happen. They're going to go up and down, and most likely going to go up, so you need to consider that. But over the course of 20 years, now my account, I'm going to assume, got an after-tax return of 4%, which isn't great, but you have to understand that you're growing and being taxed on the growth because it's not in an RSP or a TFSA. So after 20 years, I now have about $219,000. I sell it, I pay back the $100,000, I have $119,000 that I didn't have before. So how does that look compared to me putting $333 a month into an account for 20 years? Well, it's about equivalent. So it's not that great. I am up actually $3,000, $122,000 in that case. But remember how I told you it's only like you're putting $200 a month into this because of the tax savings. So in that case, putting $200 a month into this account for 20 years, I now have $73,000. So I'm actually doing quite a bit better in that case scenario. Now obviously that's not great returns, and the market can produce much higher returns than that. So let's look at 5, 6, and 7% just to see how that would look. 5%. After you paid back the loan, you'd have $165,000 in 20 years. 6%, $220,000, and 7%, about $287,000. So now we're talking about how that's like really starting to make sense. That's a good investment. You've made a lot of money for a very little amount of money that you had to put in. So personally, I like leverages. If I'm ever going to do another one again, I'm going to make sure that I do it once I've seen the market take a big drop. So I'll probably do that next time that I say, oh, the market has dropped so much, as long as I don't have to put a whole bunch of money back into K4 at the time. And as I said, I mean, they're just not for everybody, but they can be a really good choice, a really good way to build some extra wealth if it's right for you. So just like anything, do your research. If you feel comfortable, start with one. You don't have to do a huge one, and go from there and see if it makes sense to you. Thank you very much. Please subscribe.